started by first talking about the global setup once again. Marc Franklin, Deputy Head of Multi-Asset Solutions Asia at Manulife Investments, is with us now. Marc, good morning. Thanks very much for joining us on the show today. So, I just want to understand what kind of shifts, if at all, you have planned or you have executed in the strategy in your portfolios since this big event happened, this window of conversation between China and the US, the lowering of tariffs, and at least this 90-day pause that we've got. I mean, we've seen that play out in markets, right? We've seen some tactical money shift to China. We've seen the cool off in gold. We've seen, in general, commodities start to move higher. But as an asset manager, what are the changes, if any, that you are looking at now?
Good morning. Well, if you look at the V-shaped experience that equity markets have given us over the last few weeks, it's created a number of opportunities. The first opportunity is to increasingly diversify our global equities exposure. So to lean a bit more on those regions ex the US. So you mentioned Asia, to some extent Europe and Japan as well. So we're looking for more of a breadth of participation, which founds itself on the idea that valuations increasingly will matter, risk premium will matter, particularly if markets pursue a more volatile, choppier experience over the rest of the year. The second thing that we've done in more recent times is the acknowledgement as a result of the thaw in the trade dynamics, the relation between the US and China in particular. It sort of takes the worst case scenario for the macro outlook off the table for the time being, not permanently so. And what that means in practice is that the market's focus will shift increasingly on the next policy initiative of the Trump administration, which will be tax cuts, spending plans, which are generally expected to be somewhat reflationary. The consequence of that is that we're starting to lighten up a little bit on our bond exposure, particularly US Treasuries, because the economic risks are being somewhat priced out again. And the focus will be more on a reflationary policy mix in terms of the potential. And so not just the curve steepening, but the whole of the yield curve starting to move higher as a more benign growth outlook becomes the base case again. Of course, we do recognize that narratives can subsequently shift again, but that's what we've been doing in most recent times, is just lightening up a little bit on those more defensive exposures.
Marc, hi, morning. Let's talk about India. The many factors which were supportive of India over the last few months, whether it's lower dollar, lower crude prices, trade headwinds on China, they've all reversed. So while India, in a way, is still relatively insulated from the disruptions that we're seeing, has the sheen come off the Indian equity markets, to your mind?
We also have to bring into the equation the geopolitical dynamics as well. Thankfully, it looks like things are paused there, cooling down. That was perhaps something which represented a bit of a tangential risk to investor appetite for Indian equities. So with that put to one side for the time being, I think that foreign investors are taking a fresh look at India again, not just for the construct of the economy and markets being somewhat more domestically oriented, but the recognition that positioning, particularly amongst foreign investors, is somewhat lighter now than it was 6 months ago. And therefore, there's the potential for a re-engagement and for overseas flows to come back into the market. So we are somewhat more constructive on Indian equities at this point in time, but we do recognize that we have to be somewhat price sensitive, given that valuation multiples never really got that discounted, both relative to history, but also relative to other markets as well.
Hi, Marc. Good morning and good to see you, Ben. You had pointed out that the Indian markets are not particularly cheap. So I think this time correction, price correction, I think that will, hold well. But in terms of global markets, where is your preference right now? The US markets, there were a good amount of longs that were added in the initial part of the calendar year, which got unbound. So give and take everything, what's your top global equity market that you're looking at?
We take a barbell approach at the moment. As I mentioned earlier, a more diversified global equities portfolio than we would have run maybe 6 months ago. And so on one side of that barbell is looking for markets which are somewhat discounted relative to fundamentals and also give you a nice total return potential, not just from capital returns, but also from income. And a market that does fall into that category is the UK large caps, very discounted market, a good dividend profile, and not a reflection of the domestic UK economy, which we know has somewhat of a challenged picture. So that's an example of discounted valuations that we like. We also think that Asian equities also fall into that category as well. And then on the other side of the equation is still looking for those businesses which give you franchise value, thematic growth potential. In that context, we like cybersecurity. We also like defense technology as well. So these are sectors that are not inexpensive. They're somewhat premium valuations, but we can see with a degree of confidence that over the next several years, there's going to be a nice compound growth potential. And so the market will eventually reward that because of the delivery of earnings growth. So combination of earnings growth thematic strength alongside those discounted parts of global equity markets, which gives us a nice blend.
All right, Marc, we'll then leave it on that note. Thank you very much. Appreciate the perspective that you've given us today. Thank you very much for joining in. Well, that's one view.